Welcome to the Deep Dive podcast, where we refuse to just skim the headlines. In the world of enterprise software, the stakes are too high for fluff. You need to know what's really going on beneath the surface.
Whether you're looking at a complex software implementation, improving your accounting controls, or a new security protocol, you need to understand how things really work when the rubber meets the road. I'm Ryan Caldwell. I'm here to help break down those complex ideas and systems so they actually make sense for your day-to-day.
And I'm Morgan Hale. I'm here to keep us focused on the big picture and ensure we get straight to the actionable insights you need to lead. Together, we'll talk with you like the advisors you'd hire to overhaul your tech stack.
We call this the Deep Dive. We are exploring the tools that power your business, from accounting and real estate to high-stakes security.
So if you're a CEO, a franchise director, CFO, or CTO, and you're looking for thorough analysis, you've found your home.
Let's get into it.
Let's dive in. Have you ever been out to dinner with just a huge group of friends? You know the drill. It's a birthday, maybe a reunion. There are like 10, maybe 12 people all squeezed around one table.
Oh, the chaos of the long table.
Yeah.
Absolutely. You can't hear the person at the other end, but you know they're ordering the expensive appetizers.
Exactly. And the food's great, the conversation is flowing, everyone's having a good time, but then the music stops. The waiter drops the check right in the middle of the table.
The moment of truth, the panic sets in.
Right. And everyone starts doing that awkward pat down of their pockets. Oh, I only have a 20. I didn't have any wine. Why is my share $50? And usually there's that one friend, let's just call him Dave, who kind of sighs, grabs the check and says, you know what? I'll just put it on my card for the points. You guys just Venmo me later.
Dave is the hero of the evening.
Mm-hmm.
Or maybe the martyr, depending on how long it takes everyone to actually pay him back.
Precisely. Now, I want you to picture that scenario, but scale it up. Instead of a $300 dinner bill for pasta and wine, imagine a purchase order for, say, $10 million of raw industrial materials.
Okay.
And instead of your college buddies, imagine a complex web of 50 different corporate entities that all technically belong to the same family, but have totally different bank accounts.
Right. That is where the Venmo me strategy falls apart pretty quickly. And that is exactly what we're unpacking today.
We are doing a deep dive into a guide on the essential vocabulary of intercompany billing. Now, I'm going to be honest with you. When I first saw the topic billing vocabulary, I thought, okay, this might be drier than overcooked turkey.
It's a common reaction. Accounting doesn't usually scream thriller, but, stick with us.
I realized pretty quickly this isn't just about accounting terms. It's actually a fascinating look at the plumbing of big business. It's about how money moves when a company basically buys things for itself. But not really.
It's the who owes whom in a corporate family tree. And honestly, if you don't get this vocabulary right, multinational corporations they essentially grind to a halt. It's the oil in the engine.
So our mission today is to decode this financial language. We're going to move from the chaos of that dinner bill to the zen of what they call the pass-through expense.
Let's dive in.
So to set the stage, the source material describes a very specific kind of organizational structure. We aren't talking about a mom-and-pop bakery here.
No. We're looking at a large-scale organization. Usually this involves a holding company. You can think of that as the parent. And then underneath that parent, you have all these child companies operating under the umbrella. They might be in different states, different countries, selling completely different things.
So you can have a parent company in New York, a manufacturing arm in Ohio, a sales division in London, and then, I don't know, a tech support branch in India.
Exactly. They are all family, but legally, they are distinct entities.
And just like a family buying groceries at Costco to save a few bucks, there's a big motivation for these companies to shop together, right?
It's all about leverage. The source explicitly mentions that these organizations make purchases in bulk to get better pricing and terms.
Yeah.
It's centralized procurement 101.
Centralized procurement. That sounds very official, but the logic is pretty intuitive. If I'm the Ohio manufacturing plant and I try to buy steel, I'm a small fish.
Right. If you buy one laptop or 1 ton of steel, you pay retail. You have no bargaining power. But if the parent company steps in and says, look, we aren't buying one laptop, we are buying 5,000 laptops for our entire global workforce, Suddenly the whole conversation changes.
You get the VIP treatment.
You get a massive discount, you get better payment terms, maybe you have 90 days to pay instead of 30, you have power over the vendor. It's a huge competitive advantage to buy as a group.
Okay, so the logic is sound. Buy big, save money, everyone wins. But here comes the Dave at dinner problem we talked about.
The logistical snag.
Yeah.
Even though you're buying in bulk for the whole group, usually the items are ordered and paid for by just one of those companies, usually the parent company, or maybe a specific entity set up just to do the buying.
So company A whips out the corporate credit card, metaphorically speaking, of course, and pays for the entire shipment. $10 million, gone.
Right. But that shipment isn't just for company A. Whatever was bought, whether it's software licenses, raw materials, or 10,000 ergonomic office chairs, that's all going to be distributed. Company B gets some, Company C gets some, Company D gets some.
So Company A paid for it, but everyone else is now sitting in the comfortable chairs.
And that creates the core conflict. The company that paid the bill must be paid back by each of the other companies that got the goods.
I want to pause on that word must, because I feel like some people listening might think, well, why? Since they're all owned by the same person at the top. Let's say it's some giant conglomerate.
Yeah.
Does it really matter which pocket the money comes from? Isn't it all just one big pot of money?
That is the most common misconception. It matters immensely.
Right.
Legally and tax-wise, these are separate entities. I mean, imagine if Company A pays for Company B's expenses and just never gets paid back.
Company A looks poorer than it actually is.
And Company B looks richer than it actually is because they just got free stuff. That totally distorts the performance of both companies.
Wow.
If I'm the manager of Company B, I look like a genius because my costs are zero.
Ah, I see. So it messes up the scoreboard.
It messes up the scoreboard, but it also messes up taxes. If Company B is in a country with high taxes and they don't record that expense, they show too much profit and end up paying way too much tax. Or vice versa. The tax authorities do not like gifts between corporations. You have to settle the score.
Okay, so it's the Venmo me moment, but it's not just about fairness. It's about the law, it's about taxes, and it's about actually knowing which part of your business is making money.
Precisely. And that is the foundation of intercompany billing. It sounds simple, just pay me back. But in the world of accounting, you need a rigorous system to track that. You can't just send a text message.
The source mentions that there was, and honestly in many places there still is, a traditional way of doing this. And reading about it, it sounded like a nightmare. It's called pay to pay from.
Pay to pay from. It's a bit of a tongue twister, isn't it?
It sounds less like a financial strategy and more like a bad dance move from the 80s.
In traditional accounting, this was just how they tracked these expenses on the balance sheet. It relies entirely on manual journal entries.
Walk us through that. Like, how does it work physically? Let's say I'm Company A, I bought the stuff. You're Company B, you took the stuff.
Okay, so I'm the accountant at Company A. I see we spent money for you. I have to physically go into my general ledger, my book of record, and type in a journal entry. It says, intercompany receivable, Company B owes us $10,000. I have to code it, date it, describe it.
Okay, step one. That sounds tedious, but doable. I'm guessing I have to do something on my end, too.
You do. You, the accountant at Company B, have to go into your books, which, by the way, might be a totally different software system, and make a separate manual entry recording that you have an intercompany payable to Company A for $10,000.
So everything is double entered by two different people in two different systems.
Manual. Every single time. For every single transaction, the source actually uses some very specific adjectives to describe this method.
Oh, I caught those. Very manual, very time-consuming. And the big one, very prone to error.
It's a recipe for disaster. Think about the human element. Maybe I record the entry on the 31st of the month because I want to close my books, but maybe you're on vacation or you just forget and you don't record your side until the 2nd of the next month.
And now our books don't match for that month?
Exactly. My books say you owe me. Your books say nothing. Or maybe I type in $10,000 and you accidentally type in $1,000 because your finger slipped.
A mismatch.
A massive mismatch. And that leads to the final consequence mentioned in the text. Constant reconciliation. This is the bane of every accountant's existence.
Reconciliation? That sounds like making up after a fight.
In accounting, it's more like detective work. At the end of every month, instead of going home to their families, accountants are digging through thousands of lines of Excel spreadsheets, trying to figure out why Company A says they're owed $1 million and Company B says they only owe $900,000.
That sounds like spending your entire weekend figuring out why your checkbook is off by 3 cents, but with millions of dollars and your job on the line.
That is exactly what it is. It's incredibly inefficient. It locks up cash, it wastes time, and it makes the financial data unreliable. And if you can't trust the numbers, you can't run the business, which is why understanding the vocabulary of how to do this right, moving away from just scribbling in journals, is so critical.
So we need a better system. We need to stop treating this like a favor between friends and start treating it like a real business. And this brings us to the part of the deep dive where we have to rewire our brains a little bit. Because the source says we need to treat these internal transfers just like external business. It talks about customers and suppliers.
Yes, and this is the mental shift. And it's actually harder than it sounds.
Right, because when I hear customer, I think of someone walking into a store, browsing the aisles, buying a pair of jeans. I think of the customer is always right. But that's not what we're talking about here, is it?
No, and this is where people get tripped up. I mean, if you work in a subsidiary, it feels weird to call your parent company a supplier or your sister company a customer. You know them, you see them at the Christmas party, you use the same email domain.
Exactly. Customer implies a stranger almost. It feels cold.
But we have to look at the strict accounting definition. In accounting terms, a customer is simply defined as anyone who owes the company money.
Anyone, even if they sit in the office next door.
Anyone. So in the context of intercompany billing, who is the customer?
It's the other company within the group.
Exactly. The customer is the entity inside your own organization that owes you money because you bought something for them.
That feels so weird, calling your sister company your customer.
It does, but financially, the relationship is identical to a stranger buying those jeans.
Yeah.
They have a debt to you, therefore they are a customer. You have to formalize it. By calling them a customer, you create a process.
Okay, so let's flip it. What about supplier? Usually that's the vendor selling me the goods, the person delivering the milk.
In standard terms, yes. But the accounting definition of a supplier is simply anyone you owe money to.
So if my sister company paid for my goods and I owe them,
Then that sister company is your supplier. You have to set them up in your system just like you set up the electric company or the milk delivery guy.
so let's visualize this. Company A buys the laptops. Company B gets the laptops. Company B looks at Company A and says, hello, supplier. And Company A looks at Company B and says, hello, customer.
Precisely. Even though they might share the same logo on the building and have the same owner, financially, they treat each other as distinct trading partners.
It's strictly business at the family reunion.
It has to be. Otherwise, you can't track where the money actually went. If you don't treat the internal company like a customer, you never generate the formal demand for payment. You're right back to that pay-to-pay-from nightmare of hoping someone remembers to write a journal entry. By using customer and supplier, you can use the automated systems that already exist for billing.
Speaking of demanding payment, let's talk about getting that money back. The source lists a couple of terms here: reimbursement and recovery.
Right, and this is a quick win for anyone listening who gets bogged down in corporate jargon. These terms are completely interchangeable.
Oh, really? There's no subtle nuance there. Usually there's some kind of catch.
Not in this context.
Right.
If you hear an accountant talk about expenses to be recovered or another one talks about reimbursable expenses, they are talking about the exact same thing. Do not let the jargon fool you. It just means getting paid back.
Good to know. Because sometimes people use big words just to sound smart or, complicate things.
In finance, never.
Right. But there is a distinction made in the paperwork where the words actually do matter, specifically between an invoice and a bill. Now, in my daily life, I use these words interchangeably. Send me the bill, send me the invoice, same thing.
In casual conversation, sure, you can say whatever you want. But in the architecture of a billing system, the difference is critical. It depends entirely on whose hands the paper or the data file is in. It's all about perspective.
Break it down for us. Why does it matter which word we use?
Okay, let's go back to our scenario. You are Company A. You paid for the goods. You want your money back from Company B. You generate a document to send to them. That charge you send out,
Yeah.
that is the invoice.
The invoice is the I want my money back document. It's outbound.
Correct. It initiates the request. Now, switch seats. Imagine you're Company B. You receive that document. You look at it and realize, okay, I have to pay this. To you, that document is a bill.
So the bill is the I owe you document. It's inbound.
Exactly. It's the same piece of paper with the same PDF. But when I send it, I call it an invoice. When you receive it, you call it a bill.
That is actually incredibly helpful clarity. It tells you immediately which side of the transaction you're sitting on.
Right. If you have a stack of invoices on your desk, you're waiting for money to come in. If you have a stack of bills, you better get your checkbook out. And in automated systems, this is crucial.
Why is it crucial for the system?
Because an invoice triggers one set of automated workflows, sending reminders, tracking how old the debt is. A bill triggers a completely different workflow: approvals, budget checks, payment scheduling. If you mix them up, the machine just jams. You don't want to try to pay an invoice you sent, and you don't want to collect on a bill you owe.
Which leads us perfectly to the big picture, because companies don't just deal with one invoice or one bill, they deal with thousands, and they need to know their total exposure.
And that's where we get into the acronyms: AR and AP.
Accounts receivable and accounts payable. I feel like these are terms people hear all the time, maybe on CNBC or in a quarterly meeting, but maybe they just nod along without fully visualizing them.
Let's visualize them. We just talked about the invoice, the request for money. Accounts receivable, or AR, is simply the sum total of all those unpaid invoices.
From all your customers.
From everyone. If you have 5 sister companies and they each owe you 10 grand, plus you have external customers who owe you money, your accounts receivable balance is the total pile of cash that is owed to you.
It's basically your expected cash.
Yes. And for a company, high AR can be a problem if nobody's paying you. You can't pay your own staff with accounts receivable. You need actual cash. So tracking AR tells you how efficient you are collecting.
Okay. And conversely?
Accounts payable, or AP, is the sum total of all the unpaid bills. It's the pile of debt you owe to your suppliers, whether those are external vendors or internal sister companies.
So AR is money coming in hopefully soon, and AP is money going out eventually.
That's the simplified view, yeah. And for the health of the company, you obviously want to keep a close eye on both. But here is the insight regarding intercompany billing. If your intercompany AR and AP are messy, it means money is trapped inside your own organization.
Trapped. That sounds ominous.
But it is. If company A thinks it's owed money, which is an AR, but company B hasn't processed the bill, the AP, that capital is in limbo. You can't use it. It's just stuck in the pipes. That's why getting the definitions of invoice versus bill right matters. It keeps the flow moving so the money lands where it's supposed to be.
It's incredible how much friction can be caused just by bad vocabulary.
It really is.
Huh?
Efficiency is often just about everyone speaking the same language.
Now, there is one last term in the source that I found really interesting. It almost sounds like a magic trick. The pass-through expense.
Ah, yes.
Oh.
The pass-through. This is the ultimate goal of intercompany billing for the company that made the original purchase.
Define it for us.
A pass-through expense is an expense that you pay, but somebody else is paying you back.
Okay. Simple enough. It's like a hot potato. I caught it, but I'm just tossing it to you.
Exactly. But the key here is the financial reality of it. The source puts it very simply. It costs you nothing.
Nothing. But I wrote the check. I saw the money leave my account.
You wrote the check, yes. But because the reimbursement cancels out the expenditure, the net effect on your profit and loss statement is zero.
So let's trace the path. I spent $1 million on raw materials. That looks like a huge hit to my bank account. My stomach drops.
It does. If you stop there, your quarterly report looks terrible. You're $1 million in the hole.
But then I invoice my sister companies for that $1 million, and they pay me back.
And suddenly, that $1 million expense,
Mm-hmm.
it just vanishes from your bottom line. It passed through your books. You were just the conduit.
I love the idea of being a conduit. It sounds so zen. But practically, it means the company that did the ordering isn't stuck holding the bag.
Exactly. And that's why this vocabulary matters. If you don't correctly identify that as a pass-through, if you just code it as a generic expense, your department looks like it spent a fortune it didn't need to spend.
And your bonus probably disappears.
Exactly. Or worse, the company as a whole counts the expense twice. Once when you paid it, and once when the sister company paid you back.
Oh, double counting. That sounds like a fast track to getting fired.
It is. You have to categorize it correctly so that the money and the cost lands where it actually belongs. The company that uses the goods should be the one showing the expense on their books. The company that bought the goods should show zero impact.
It really is a system of checks and balances.
It has to be. When you operate at that scale, clarity is currency. You can't run a billion-dollar conglomerate on "I'll Venmo you later."
So let's recap what we've unpacked here, because we've covered a lot of ground, from dinner tables to corporate boardrooms. We started with the dinner bill problem, buying in bulk to save money, but creating a logistical headache of who owes whom.
We looked at the old way pay to pay from, which was a manual, error-prone nightmare of double-sided journal entries that kept accountants up at night.
And we realized that was unsustainable. So we redefined our relationships. We learned that your sister company isn't just your friend, they are your customer if they owe you, and your supplier if you owe them.
And that perspective shift is key. It feels unnatural at first, but it allows you to use standard business processes, invoices, and bills to automate the flow of money.
We clarified the paperwork, sent an invoice to get paid, receive a bill to pay up, and we looked at the totals AR for what's coming in, AP for what's going out.
And if you keep those clean, the money flows.
And finally, the pass-through expense, the perfect zero-sum game where you facilitate the purchase but you don't bear the cost.
It's a beautiful system when it works. It turns chaos into data.
It really is. You know, it reminds you that businesses, no matter how big, are really just collections of agreements and ledgers.
That's true. At the end of the day, it's all about trust and verification.
And if you don't have the right words to describe those agreements, if you don't know an invoice from a bill, the whole thing falls apart.
Language defines the reality of the money.
So here is a thought to leave you with, listeners. We talked about the pass-through expense, the idea that if you spend $1 million but get reimbursed $1 million, it costs you nothing.
Right. The net zero.
But think about that for a second.
Yeah.
Millions of dollars moved. Goods were bought, trucks were loaded, services were rendered, real energy was expended. But for the entity that wrote the check, did they actually spend anything?
Philosophically.
Yeah. It challenges the very definition of spending in a corporate web. At what point does money stop being value and just become data moving between columns? If you're just a conduit, are you even a business or just a bank account with a logo?
That is a very deep rabbit hole.
Mm-hmm.
And probably why accountants get paid the big bucks to keep track of it all. They are the keepers of the reality.
Something to mull over next time you split a dinner bill and wonder if you're the customer, the supplier, or just the pass-through. Thanks for diving in with us.
See you next time. That's our show for today, about the vocabulary of intercompany billing. Join us next time for another deep dive into an interesting, timely, or just plain complex topic in the world of enterprise software.
Our show today was produced by Joseph De La Pena, with help from Barbara Medea and Millie Saw.
Fact-checking by Cheryl Wellman, CPA. See you next time on The Deep Dive.
Floating like a butterfly, no set afloat, sung